Good afternoon, everybody. Thanks a lot for coming, and welcome to the Global Economy Lecture today. It's actually an event that takes place since 1999, together with the wiiw. So Robert Stehrer, thanks a lot for the cooperation on this lecture. It's a distinguished lecture series on the global economy with lots of important and famous speakers. Last year we had Ralph Oster from the WTO, the chief economist. The year before it was Carmen Reinhardt. And this year I'm very happy to welcome Silvana Tenreyro as our speaker today. It's a great pleasure to have you here, and I think we start with a big round of applause for Silvana for being here and giving the lecture. I think she needs no introduction, but let me just take a couple of minutes to introduce her very briefly. This shows very quickly why she is the excellent candidate or the excellent lecturer for this series. She is first of all professor at the London School of Economics. She earned a PhD at Harvard University. She has a very impressive list of publications in the top journals. She has such impressive list of prizes, distinguished prizes and awards over the last years that it's too many to actually mention. She has been the president of the European Economic Association. She has been the external member of the Bank of England's Monetary Policy Committee. So she bridges academic work, monetary policy, and trade theory and policy, but also monetary policy. So there is a lot that relates to what we do here at the Austrian Central Bank, and there's a lot that bridges work in the real economy to the monetary part of the economy. I want to thank at the beginning everybody who was involved in preparing that event in the Department of Economics here at the Austrian Central Bank, but also, of course, in the events team. We'll have a presentation by Silvana at the beginning, and then there will be a discussion with questions from the floor, and Robert was so kind to moderate and keep the time and take questions and lead the discussion. I'm looking forward to a very interesting late afternoon today. I'm sure it will be intellectually very stimulating, and I ask you, Silvana, now to take the floor and give your lecture. Thanks a lot.
Thank you very much for the introduction, and thank you for having me here. It's really a pleasure to give this lecture. So there's a lot going on at the moment in economics and in politics, but in my talk I'll try to talk about the big picture, where we are coming from, where we now, and where we might be heading to. And then, if there's time, I will try to talk about policy space in central banks at the end. So let me start from where we are coming from. Big picture, we have two colossal, once-in-a-generation shocks, the pandemic and the Russian invasion of Ukraine, which led to an extraordinary increase in the prices of energy and other commodities. Adding to Brexit, this was the most remarkable concentration of tail events, or rare events, as we call them. And to give a sense of magnitude, the increase in energy prices alone was larger than what we had experienced back in the 1970s. This is illustrated in this chart, which shows the evolution of crude oil prices and European natural prices. And as you can see clearly here, the 2020s were at least as bad as the 1970s. These are global wholesale prices. Let me show you what happened to retail prices, what households and companies actually pay. This is illustrated in this chart. We can see in blue the cumulative path for energy prices in the US. In orange, we have the same for the euro area, and in green, the UK. And as we can see, the cumulative increase in energy prices in the euro area was much larger than in the US, peaking at around 80% compared to a peak of around 40% for the US. And you can see the gap sustaining itself, a gap of around 20 percentage points for a few years. This is huge. And if you thought the euro area is bad, the UK was even worse, with cumulative increases peaking at 115%, 80 percentage points higher than in the US. This is, again, the component that directly goes into the CPI basket. Now, crucially, and this is a key distinction between Europe and the US, for Europe and the UK, the increase in energy and commodity prices represented a negative terms of trade shock, akin to a negative supply shock, because Europe and the UK are net importers of energy and other commodities. For the US, instead, as a net exporter of commodities, this represented a positive terms of trade shock, a positive boost to its external demand. And that's very different. The US, as you know, is also a main exporter of defense and military equipment, so the invasion and any wars represents yet another boost to its external demand. And this is important because negative terms of trade shock pose a very difficult trade-off for central banks. They push up on prices and depress activity. And I'll come back to this point later. And this is, of course, not just a story of energy prices or commodity prices. We were coming from the pandemic, which had led to a big increase in the demand for goods over services, which clash with a restricted supply of goods, global goods, and that led to a big increase in global good prices. This index here shows supply chain pressures globally, and we saw them spiking up during the pandemic and during the Russian invasion of Ukraine. They have now normalized. Now, this global shock was obviously common to all countries, but what was different across the Atlantic was the response of fiscal policy, which in the US was much, much larger than in Europe. And we saw that reflected in US households' real incomes, which, as you can see in blue here, they went above their pre-COVID trends early in 2020. So there was really no recession in income space for households in the US. Whereas in Europe and in the UK, in the euro area and the UK, we saw real households' incomes fall below their pre-COVID trends. So just to summarize, these global shocks had very different impacts in Europe and in the US. In the US, effectively, there was a positive terms of trade shock, plus a very large fiscal stimulus. Whereas in Europe and in the UK, we had a negative terms of trade shock, more like a negative supply shock, and that led to a more difficult trade-off for policymakers. Now, as you know, monetary policy is an aggregate demand tool. By increasing interest rates, central banks can lower inflation, but that entails reducing activity, reducing demand. Now, when inflation is driven by demand, as was the case mostly in the US, then we face what macroeconomists call the divine coincidence. By increasing interest rates, you restore inflation to its target and output to its supply potential. However, when inflation is driven by cost push shocks or supply shocks, like what we saw in Europe, then central banks face a difficult trade-off. By increasing interest rates to reduce inflation, they also exacerbate the weakness in activity caused by the shock. And this is why this distinction matters so much during this period. Now, as it happened, the ECB, the Fed, the Bank of England increased their policy rates by roughly the same magnitudes over this period, roughly 4.5 to 5 percentage points, as you see illustrated here. But as I said, what was different was the source of the shock, and we saw that reflected in measures of aggregate demand. So here I'm plotting consumption for the three jurisdictions, and as you can see in the US, consumption went down early in the pandemic, but then recovered quite quickly and grew above its pre-COVID, pre-pandemic trend. In the opposite extreme, we have the UK, where we see a much larger drop in consumption, as you see illustrated in the far right, and consumption recovered much more slowly. If you look at today, consumption is barely at the level it was back in 2019. And Europe is somewhere in the middle, with consumption just above that pre-COVID level, but well below the pre-COVID trend. That compares to consumption in the US, where it's more than 15% higher than what it was back in before the pandemic. So these are big differences in performances, explained to a large extent by the different nature of the shocks hitting them. Now, if we look at household inflation expectations, you can see in blue here, I mean, for the three regions, US, Euro area, and the United Kingdom, long-term inflation expectations for households, pictured here in blue, didn't move much. What moved a lot were the short-term measures of inflation expectations, particularly in the US, where they were following basically the dynamics of inflation in the short run. And if we look at longer-term measures of inflation expectations from financial markets, they also increased quite a bit during the pandemic and the war, and they've been converging back since. In the case of the Euro area, arguably inflation expectations were the anchor before the pandemic, and now they are coming back to the 2%. They had been undershooting the target for a long time. Now, as I said, the inflation dynamics in the end for these three jurisdictions was very similar, as you can see towards the end of the chart, with inflation coming up and down fairly quickly if we think about what happened in the 1970s and 1980s. So to some extent, I would say that I mean, obviously, these shocks were a big test to the policy framework that we have in central banks today, and effectively we had a 1970s shocks plus a pandemic with a post-1990s policy framework. And the outcome was a positive one, given the underlying shocks. Inflation went back to target relatively quickly, given the transmission lags of monetary policy. It takes time for monetary policy to really hit inflation, and in all, inflation was back to target within that 3-year horizon that policymakers tend to have in mind. So the takeaway is that the monetary policy framework is quite robust, even to these outsized tail events. Now, just a parenthesis here to say that the combination of supply shocks and the lags in the transmission of monetary policy are the reason why most central banks today have flexible inflation targeting regimes rather than strict inflation targeting regimes. You cannot have inflation at the target all the time. Sometimes when you're hit by these very large shocks, there are trade-offs, and when that happens, it takes a bit longer to return inflation to target, and that's part of the trade-off. The key here is try to keep long-term inflation expectations anchored and try to minimize losses in potential output for the future. Obviously, you can always hit the target by causing a massive recession, but that will have consequences for future supply potential, and that wouldn't be a desirable outcome. Okay, so where we are now, we've seen the unwind of the supply shocks and all their indirect effects. That's been in train for some time. We've also seen the effects of restrictive monetary policy with some lags. And what were the implications? Well, the unwind of the supply shock, or the reversal of the supply shock, which is effectively a positive supply shock, has led to lower inflation and stronger activity. On the other hand, restrictive monetary policy has also lowered inflation, but has put stoppers on growth, has weakened activity. And the combined effect of these two forces, supply and demand, has been lower inflation and relatively flat or stagnant activity in Europe. Let me do a couple of charts just to illustrate the point. So we started in a situation of, say, equilibrium with aggregate supply and aggregate demand. In the vertical axis, I have inflation. In the horizontal axis, I have a measure of activity. So the pandemic and the Russian invasion of Ukraine led to a contraction of supply, and that pushed up on prices, or inflation, and depressed activity in the horizontal axis. Now came in monetary policy, which lowered aggregate demand and led to lower inflation and lower activity, so exacerbating the initial falls in activity. Since then, we've seen supply improving, and so we're getting back to our initial aggregate supply curve, and aggregate demand, I mean the lowering of rates by central banks, is bringing us back to the original aggregate demand. So that has been, in pictures, a summary of what we went through over these past 5 years. And it's all, I guess, well captured by what happened to aggregate GDP in these economies. We saw the big fall in activity during the pandemic and the war in Ukraine. The most affected one of these three was the UK, and the US in the other extreme came out very quickly and started rising growing above its pre-COVID trend very early in the pandemic. And the euro area fell somewhere in the middle between these two extremes. Now, what happens next? Where we might be heading? Well, in the very short term, we are basically witnessing the introduction of tariffs and trade wars, and all in the middle of a lot of uncertainty on the policy domain. So we can see, as an illustration, on the left you can see the evolution of tariffs since the late 1800s, and you can see that over this long period of time, tariffs have been falling, particularly since the 1930s. We see towards the end of the graph, I don't know if I can put, the increases in tariffs during the first Trump administration. Some of it came down a little bit, and since then we've seen the big spike in tariffs to an average of around 17% effective tariffs. That was not a straight jump. Here you can, I'm zooming in on what happened since January 25 until now. How we got to that 17% tariffs. So these are the many announcements we had, the average of all of those. And then eventually we settled as of today in around 17%. And this takes into account all the exemptions that were introduced since. Now, one thing to take into account is that the US today is obviously more open than it was back in the past, so the impact of these tariffs on US activity will be higher than what it was. I mean, it's almost it's twice as open than it was in the past. But having said that, I mean, all of this is surrounded by a lot of uncertainty that's picked up in many indices. This is an index of trade policy uncertainty put together by people in the Fed. And we can see the big spikes during or after Liberation Day. That came off a little bit, but is still highly elevated relative to the recent history. So what can we say about tariffs? Again, there's a lot of uncertainty, so we don't know what will happen exactly, but with some confidence, at least qualitatively, we can conjecture that it will have an adverse impact on global growth, relatively limited increases in US prices, and I'll walk you through those numbers, and ambiguous price effects elsewhere. So let me go a little bit through the quantitative calculation. The US is still a relatively closed economy in all. So imports in the US are 10% of its GDP. So even if you assume tariffs in the order of 55%, an increase of 55 percentage points in tariffs in the key trading partners, the Euro area, Mexico, Canada, China, which account for about 60% of the imports, or 6 percentage points of those 10, then at most an increase in tariffs will imply an increase in CPI inflation in the order of 1.5 percentage points. Okay, so that's kind of the maximum direct one-off effect. However, I mean, the effect might not be as large. In the past, and certainly in the previous Trump administration, that pass-through was reduced by a number of factors. One was the appreciation of the dollar, which didn't happen this time because there were other things happening, in particular the spike up in uncertainty, so that didn't help. Exceptions, which, as we read in the news, there are many of those, so that reduces the impact and the effective tariff rate. There is also a response by exporters that might smooth the impact by cutting prices, at least initially. We didn't see that much of that this time. We definitely saw it in the first round of Trump tariffs in his previous administration. But what we saw definitely is retailers cutting margins, for now at least. And then trade diversion will also help smoothing that pass-through. So all to make the point that we might not see the full effect of this 1.5 percentage points, and that's why, I mean, if anything, we've seen a third to a half of that. Normally, we are concerned about second-round effects. However, what's mitigating those second-round effects at the moment is that the labor market in the US is weakening, and so it's less likely that those second-round effects will have much traction. So in all, we shouldn't expect big impacts on US price inflation, though we are seeing bigger impacts on US activity. Now, in countries on which tariffs are imposed, say the Euro area or China, etc., we in principle should see lower prices because in the end this represents a decline in the demand for those countries' exports. That's true as long as there's no retaliation, which will lead to higher import prices again. So on the European side or the UK, we haven't seen retaliation really, so that's not really affecting price dynamics in that way. And in third countries, those that are not directly affected, by the tariffs, we should expect lower price pressures because, again, there are all this excess supply of goods from, say, China or Europe that are no longer being sold or reduced. Their exports are reduced given the U.S. tariffs, and they will need to find a new destination in other markets. So in those third markets, we should see downward pressures on prices. So this is just going through the list of potential factors affecting inflation that people have come up with in the past. And this is seen from the perspective of the euro area. So typically when a country imposes tariffs like the US, we should expect an appreciation, as I said before, but that hasn't happened. If anything, things moved in the other direction, so that's not there. We haven't seen retaliation from Europe. People were concerned about potential COVID-type disruptions in the supply chain. We saw a glimpse of that in the past few weeks with rare earths. Those could cause choking points, but so far that's been contained, so we are not seeing that affecting prices. So these are factors that might push up on inflation. On the factors that should push down is the adverse impact on global growth, which will slow down relative to the alternative or the counterfactual with these tariffs. We should see lower demand for European exports, which again will push down on price pressures, and excess supply of foreign goods, for example, from China, which, as I said before, will need to find a new destination. There's a seventh factor that these economists have been talking about, the potential for foreign companies to increase markups everywhere to make up for the losses in US markets. Again, we haven't seen much of that, but it's a potential risk factor to keep track of. Let me, in light of that, talk a little bit about central banks, given that we are in one of them. How should central banks react to that? Well, for third countries, there's no trade-off. These tariffs are pushing down on inflation, pushing down on activity. So the direction for policy is basically try to compensate for that lower demand by having a more expansionary monetary policy. For the US or countries imposing retaliatory tariffs, there's a trade-off. We have lower activity and higher price pressures. I argue that those price pressures are relatively small. So there's an argument for the Fed to see through, and I think that's where they got to. They were initially very reluctant to see through, worried about potential second round effects, but now I think the Fed is coming to the view that it could see through some of these effects, particularly with a weakening labor market. Of course, if these price effects become more substantial, and they might be in other markets, or if they detect risks of second round effects or sudden tightenings in the labor market, then it's harder to see through these effects, and they will have to tighten relative to the counterfactual of no tariffs. So effectively, it means delaying the loosening in monetary policy. Now, for all countries, there is increased uncertainty, and this is a negative shock to demand. So again, this should be assessed and put it in the equation with all the other factors, as it may affect investment decisions and by companies and also households. So where we might be heading, just keep an eye on the time. So I think there are 4 factors in the minds of most economists these days. So in Europe, one important factor is the increase in defense and infrastructure spending, which should give a boost to demand, particularly in Germany, that has had a very weak performance within the Union. Second, and we've seen already some of that, is a migration of investments away from the dollar. I mean, the dollar will not lose its dollar dominance, but certainly some of the weight has been rebalanced in global portfolios, and we might see some of that. So a little bit of less dominance, still dominance, but less than before. Further economic fragmentation and climate change will keep being the risk factors in the horizon, which can lead to adverse effects on productivity. This is not just a one side. I mean, we live in in general equilibrium. There is a weakening of the supply side that will eventually also affect demand. How quickly it happens? Well, it depends on how quickly investors anticipate those negative effects on productivity. So some of these effects can materialize in lower demand pretty early on. And finally is AI with its promised positive effect on productivity. Interestingly, adoption rates in Europe are very high, by some metrics even higher than in the US, so this is happening at speed in Europe. Again, it will have the effects on both supply and demand, and the big worry is how much it will disrupt the labor market, particularly amongst young people who might be easily substituted by some of these AI tools. And there's very nice work being done at CEU here in Vienna by Miklos Koren and Shufi Barani on the impact that can have on future human capital and human capital accumulation. So this is something that we should worry. If we're not training young people today because of AI, I mean, it's easy to substitute perhaps, but that means that in the future we will not have the strong human capital that we may have wished. So just 4 takes away from the talk so far. First, despite this having had global shocks that affected everyone, the effective impact on the US and Europe was really quite different. The US faced a positive terms of trade shock and a very large fiscal stimulus, whereas in Europe the shock was really a negative supply shock, and the stimulus wasn't as large. We had similar inflation dynamics, but hugely different experiences in terms of activity, consumption, investment, and so on. We can say that the policy framework that we have in central banks worked fairly well, given the size of the shocks that we faced. Again, 1970s plus pandemic, all together, we got inflation back to target within a reasonable period of time with limited damages to supply potential. And unemployment super contained. So this is something positive to take away from this. We might see these divergent paths continue, especially as the US continue in its more protectionist drive, and which might be hurtful for the rest of the world, but that's a given, and I think for Europe the question is to find solutions given the cards that has been given. There will be continued uncertainty and fragmentation, which might cause a further rebalancing of portfolios, and this is where the euro might play a bigger role, particularly if Europe accelerates the pace for a digital currency, which could be a competitor to the drive towards stable coins, which are mostly dollar denominated. So let me talk a little bit about policy space. Now, what will happen if another negative shock hits us? Where, what's the space? On the fiscal front, I think there's a sense that the space is pretty limited. It was curtailed by all these shocks that we've had, and there's little appetite for increasing debt even more. On the monetary policy side, there are arguments that QE will become more challenging given political opposition to that. There are now in place stronger repo facility rates that would help with financial stability, but they're unlikely to give us much stimulus. So one thing that we should consider, at least on the margin, is negative rates, and I'll talk a little bit about this. This is part of the work I'm doing with Michael McLeay and Lucas von den Berge. So, as you know, more than a decade ago, several central banks introduced negative rates to stimulate their economies and offset disinflationary pressures. And as we saw before, with the pandemic and the large increases in energy prices, inflation surged and policy rates were increased very sharply. But now things are changing. Policy rates are falling everywhere. Inflation has fallen. Switzerland today has its policy rate at 0. Inflation is nearly 0. And so the question is, what happens, again, if we face a new disinflationary or recessionary shock? Would negative interest rates help us? Is that a tool? And why should we be concerned about negative interest rates? Well, most of the concerns come from the banking sector, potential challenges in the banking sector. So this quote is from Christian Sewing, CEO of Deutsche Bank. He has argued that negative interest rates are an irresponsible policy that ruin the financial system. So perhaps a bit extreme, but certainly he wasn't alone on this. There were other German banks that opposed negative rates. Having said that, there were other voices in the banking industry. For example, Jean-Pierre Mustier argued that negative rates had been a net positive for the banking sector because they supported the euro area economy. So the banks themselves don't agree, and that's why the model we have with Michael and Lucas is one in which there's heterogeneity in the banking sector, which can help us explain these very different views amongst bankers. And importantly, as this quote by the former CEO of UniCredit suggests, the potentially positive effects of negative rates on banks come from general equilibrium effects. So negative rates support the economies through various channels, which then feed back to banks in the form of higher loan demand, lower loan impairments, lower defaults, and so on. So to pick that up, we have a model in which there are other channels of transmission. So most of the models in the literature right now have focused on the banking sector. And that makes sense because that's where the frictions are and the interesting problems are. But by focusing only on closed economy models in which all the intermediation is done by banks, we're missing these other channels of transmission of policy which can feed back positively even to banks. So that's what we do in the paper, have a broader macroeconomic model in which part of the intermediation is done also outside banks. Now, to be clear, thinking on negative interest rates is not new. There's a long history of thought going back to Silvio Gesell and Robert Eisler. Keynes himself devotes half a chapter in the general theory talking about negative rates. He had read Silvio Gesell's work and argued that his ideas were very sound, although he found some flaws with that too. Now, recently, Ken Rogoff wondered whether Keynes might have evaluated or re-evaluated his position if he had been aware of the work by Robert Eisler on negative rates, which has been taken up more recently by Willem Voiter and others. So we go through that work. Robert, can you remind me how much time? I'm running out of time, right?
Oh, still fine.
Okay.
10 to 15 minutes.
Okay, so very quickly, let me go through some facts about interest rates. So fact number one is that household deposit rates were bounded at 0. In most countries during this period, they hit a lower bound of 0. For you can hardly see, no? Okay, can you see? I cannot see from here. Can you see the? Hardly visible. So for deposit, you have to believe me then. For corporate deposit rates actually went into negative territory. The pass-through was almost 1-to-1 there. There was no problem. But for households, there was a limit at 0, which is in large, to a large extent explained by cash, right? So households have the option to do their grocery shops with cash. That's not an option for corporate. They cannot pay the wage bill or buy machinery in cash. But for household, at least during this period, of course, the more digitalized our economy becomes, the harder it is to do our grocery shopping in cash. I mean, we pay most of our transactions now digitally, and so that's becoming more costly. But you can think that for household, at least during this period, that was available. Also, the storage costs of cash are, much smaller for households. You can put some cash under the mattress. For the corporates, that's much harder. They will need to get a safe, security guards, etc. So basically, cash was the limit for deposit rates to get stuck at 0. Cash offers a return of 0, nominal return of 0. So why would you have deposits yielding a negative rate if you can have this other option? Okay, but as I said, for corporate, that was not the story. But this is an important friction, and that will be part of our model, the 0 lower bound on deposits. The second fact that I like to stress is that the transmission from the policy rate to lending rates has been a bit delayed and partial. So in normal times, when there is a cut in the policy rate, that leads to a cut almost 1-for-1 in lending rates. This time, the pass-through was in the order of 50% with negative rates. Okay, so that's something that we should expect to see across Europe. The average pass-through was in the order of 50% rather than 1. The third observation is that despite the complaints, aggregate banking profitability was not adversely affected by the move into negative territory. And that might be surprising, certainly was surprising for me. With the return on reserves falling and deposit rates stuck at 0, you would expect a fall in profitability, but that's not what we saw on aggregating. If anything, the return on equity for banks increased in some countries during this period. Okay, and this is just the raw data. There are some more refined papers doing a much better job at causally identifying the effect of negative rates in profitability, and the conclusion there is that there's nothing to see. Profitability was barely affected by negative rates. So, I mean, there is even a very nice paper by Lopez and co-authors in the San Francisco Fed titled "The Benign Effects of Negative." The surprisingly benign effects of negative rates on banks. Having said that, I think what did happen, and this relates to the original quote, is that there was some heterogeneity across banks. So for the euro area aggregate as a whole, this is showing net interest margins, which is one of the components of profitability. For the euro area as a whole, net interest margins changed very little during this period. But for some banks, especially small cooperative banks and savings banks, profitability did fall substantially. These are banks that tend to rely on households' deposits for funding, and those were the most affected one. And this is, of course, important because it might raise issues of financial stability, competition, etc., and it's something that policymakers might want to worry about and see ways to fix it. But for the aggregate economy, and this is what we'll show later, this had very little bearing. The fifth fact I will emphasize is that other channels of transmission of negative rates through the bond market and other financial instruments work perfectly well as in normal times. So what was problematic was the pass-through to deposit and to some extent to lending, because that was somewhat muted, but everything else worked as one should expect. And this is an example with the 3-month Euribor, which moved in tandem with the policy rate. So these are the 5 facts that we try to speak to with our macro model, and there is, that's an opportunity also to speak to the existing literature. There are 4 main papers in this literature on negative rates that we think are super important. All of them have the zero lower bound on deposits, which is a key friction that makes a problem interest here. None of them has heterogeneity in the banking sector, which we think is an important dimension of the problem, and that's what we will have. And then in the middle, so these are my facts number 2 and 3. So the first 2 papers, they assume, they have as a result that when the policy rate gets into negative territory, there is a reversal of lending. Lending actually contracts. And the story there is that, for them is that all the funding for loans comes from household deposit. So if that household deposit rate is stuck at 0 and other rates are falling, then in order to keep net interest margins, they need to increase the lending rate, and that reduces loans. So they have this lending reversal result. This is the first 2 papers. At the same time, they have very small effects on profitability because, again, banks are increasing their lending rates in order to make up for the losses on interest on reserves. So the other 2 papers have the opposite results. They assume that the funding for loans comes from wholesale markets, and hence the cost of or the pricing of loans is given by the policy rate. And so there's perfect pass-through 1-to-1 from policy rates into lending rates. But the counterpart of that is that leads to big losses in profitability. You have these loans paying very low rates, deposit rates are stuck, and so the delta on that is a very big fall in profitability, which is not what we saw in the data. So somehow, these papers miss the 2 facts number 2 and 3, and this is what we try to address in our paper. So what we argue in our work is that in reality, the funding cost of loans is a blend of some household deposit funding, so deposits play a role, but also wholesale funding, which means that there is some more pass-through than the first 2 papers assume. We also have other channels of transmission of monetary policy in the paper, including the exchange rate. So we incorporate an open economy dimension there, and we allow for heterogeneity, as I said, in the banks. And so let me just, in a very quick way, try to describe the problem. So in the first set of papers, the argument is, well, we're losing our the interest on reserves is becoming negative now, so that shrinks. Deposit rates are stuck at 0, so the only hope of us to keep profitability and net interest margin is to increase the interest rate on loans, okay? And that's a reversal rate. And that's bad for central banks because that's not what you want to do when you lower rates. You would like to expand loans, okay? So that's their story. And then in this other paper, Sulati and Repulio, the idea is that loans are financed by wholesale funding, so companies can issue, or banks can issue bonds, and companies as well, and so that reduces the role of deposit funding, okay? And bonds become the marginal cost of funding, or the policy rate becomes the marginal cost of funding. This is what the actual balance sheets of banks look like in Sweden, the UK, and the euro area. So here you can see loans in light blue and dark blue. Deposits, this is corporate deposits and household deposits. As we said, for the corporate deposits, that was only a small, those are the ones in which there's no zero lower bound on the rate of deposits. So the really relevant one is this part, the bright red. And that was smaller. So the deposits in the balance sheets of banks were smaller than the volume of loans. 5 minutes, okay, very good. So we will use that in the calibration. So have some deposit funding, but also some wholesale funding, and that changes quite a bit the story. So we put this in a big macro model, and what I will show you is something that can speak to what we saw in the data. So this here shows what happens to the policy rate when you cut it in positive territory. That's when there is no zero lower bound on deposits. That's the blue line. So if you cut it and follow that blue line, the deposit rate normally falls 1-for-1. That leads to a fall 1-for-1 in the lending rate, bank equity increases, and output and inflation increase. That's a standard response to a policy rate. I'm assuming here a closed economy without any access to market-based finance by firms. Okay, so this is the simple baseline case. Now, what happens when we cut in the policy rate in negative territory? So that's the dashed red line. Well, the deposit rate is constrained at the zero lower bound. That's what we said that we would use as a constraint. The lending rate falls, but by less. Bank equity increases less than in positive territory, and output and inflation also increase, but by less. Okay, so that's the baseline, and as I said, that's a closed economy, no access to market-based finance. When we introduce access to market-based finance, we move these rates. Let me focus on output and inflation. There's a bigger impact now. You can see it in red. In output and inflation, so the policy becomes more expansionary. And if we add the closed economy, the open economy dimension, then we get to a magnitude that is comparable to what you would obtain with cutting rate in positive territory. So there is a lot of scope for monetary policy to act in the event of a recession. I mean, a lot of scope. It gives you an extra 1 percentage point of space. I mean, and the rest needs thinking. If we are hit by a bigger shock, we'll need to, really deploy other ideas. And, in thinking in those terms, let me just do the last remarks. We might be facing much tougher shocks, especially from climate change and geopolitics, and so we need to prepare for that. Monetary policy cannot solve those problems. Those are real shocks. The best monetary policy can do is bring inflation back to its target. But other than that, there's no much it can do with the real consequences of an energy shock or other shortages in critical inputs. So we really need a macro strategy to think about the big challenges. And when I think about this, I think we need at least to think about 3 pillars. One is more investment on technological diversification, and I'm talking here about critical inputs or inputs that have very low substitutability, so energy, water. Are we prepared for those, and do we need to do more investment to be ready? And within energy, I mean, the countries that did well with the energy crisis, like Switzerland, they had they switched very easily from gas to hydro, wind, solar. They were prepared, and the rest of Europe wasn't necessarily as prepared. Second is further integration, particularly amongst countries with low geopolitical risk. So that will allow us to diversify risks across suppliers and across buyers. Reshoring is not a solution. Reshoring exposes us to more domestic shocks and to risks that are hard to diversify. So we need to keep the drive, keep the push for more integration amongst geopolitically aligned countries, at least. And so if the US is moving that way, one way, we should not necessarily follow. We should keep deepening trade relations with trading partners. And the last element is some building of buffers, especially in those critical links like energy, water, and even food. We should prepare for big shocks and have a plan and a protocol to follow if we're hit by those. And I'll pause here. Thank you.
Okay, so thanks so much for walking us through the history of our problems, the current situation of our challenges, and how to say, modestly optimistic output and conclusions that the monetary framework is still working and robust. So we are facing challenges from the activity side, say, and from the fiscal space we have. So the general conclusions are very broad in a way, with also some limitations because trade for Europe is already very diverse, so we still have some little scope on that. Having said that, I wondered whether some question already from the audience. Else, well, Michael and then.
It was very comprehensive, but to my mind, not comprehensive enough in the sense that not enough was said about financial markets. I mean, we are living currently through a period where people talk about potential bubble bursting, which would lead to a rather strong further deflationary impact and asset price deflation. And what we learned, I guess, about the previous shocks was the task of the central banks was becoming much more complicated because of quite a bit of innovations which took place on financial markets. At the moment, we have this high-tech bubble, but also cryptocurrencies and so on. So I wonder whether how you would bring that into your framework. And of course, the experience from the previous financial crisis was you needed more instruments than interest rates to deal with that. So just an extension of the analysis beyond what you presented.
Take another hour. So, but yeah, I mean, I think central banks have strengthened the macroprudential framework since the financial crisis, and you know, the very positive when we had the dashboard cash back in March 2020, and even during the Russian invasion of Ukraine, when you have these big scares. The banking sector was well equipped and to deal with these shocks. I mean, that shouldn't make us complacent, and I think you know, we should be working on these areas of critical areas to see and to keep stress testing the financial system to see that we can cope with different threats, from cyber attacks to new energy or rare earth shortages, whatever we're thrown at. So that's super, super important, and I didn't want to downweigh the importance by not addressing it. And I think, there's a lot of pressure right now on deregulation, and there's a lobbying at place, and I think central banks should remain strong and should respond only to the extent that the financial framework is not weakness, but by all of these threats that we might face. But I think, we've learned a lot since the financial crisis, and I think central banks are doing their homework on, stress testing the financial system. I think the main issue right now is the rapid growth in the non-banking financial sector, and that's not, necessarily under the radar, and that's very important to figure out. And perhaps Martin has more to say about that than me.
Yeah, just one difference to the 2008-9 situation was it's unlikely to have the same degree of policy coordination, given that policy coordination is breaking down at the moment. That, of course, also refers to the analysis you conducted, yeah? If the type of monetary policy conducted is not coordinated between Federal Reserve Bank, ECB, etc. Yes.
Yeah, I think it will depend on the shock. If this is a global shock, all policies will end up moving in the same direction and will look coordinated anyway, even if, initially this is not coming from a place of collaboration or coordination. But so if it's a global shock, I would expect to see a set of policies moving in the same direction.
Okay, then in the very first row, and before that question, to the people listening online, so please type in your question into the chat, and I'll try to figure it out and then ask the question at this stage, because I'm connected to this.
So Europe is facing another big shock that you didn't talk about, and this is the China shock, and in particular Germany. So Germany is now facing the threat of losing two of its core industries, like cars and machinery tools, and to some extent chemicals, to Chinese competition. It's dramatic. It's really dramatic. You read it in the newspaper every day that workers lose their jobs. But when you look at the aggregate data, you see that it's actually really dramatic. So Germany lost its net export position with respect to cars and machinery tools to China. So Germany industrialized China with its machinery tool sector, and now it's a net importer of Chinese machinery tools. So it's a big threat. It's a bigger threat than the China shock in the US, because in the US, the China shock after China entered the WTO affected low-cost sectors like textiles and furnitures. But this China shock, some people call it the second China shock, affects core industries, high-tech industries in Germany, which are the core of the German economy. So I think your scenario that we will need negative interest rates might be a real one, because I don't know how to respond, because it's from a macro perspective. So one way out of this is defense. So one hope is that defense spending will give such a fiscal stimulus, and not only a fiscal stimulus, but it will be an innovation stimulus to the European economy, because there is a big push in Germany that defense spending goes into high-tech industries, in startups, and so on. So the hope is that defense spending, some of these firms that used to produce cars will become part of the military sector and will compensate for the market share losses that happen there. But will it be enough? Will it be enough? And I don't think it will be enough. So far, what we are observing, okay, there is not a sufficient time that has elapsed to make a judgment. So there is this hope with defense, but what can the National Bank do to help in this situation? I don't know.
It's a question for Martin.
Kocher is now the governor and has to answer this question.
Yeah, I mean, just to say, I mean, this is not a threat. It's happening already. So, and this explains some of, part of the weakness in the German economy, which has been, bottom of the euro area in terms of performance. And as you say, I mean, I don't think the central banks will be able to, change the sectoral allocation of the country. This needs, a vision that goes beyond, what, kind of country you want. Do you want that sector as part of the structure, and are you going to take industrial policy measures to deal with it? So, I mean, as you say, defense is presenting itself as a hope to rescue the sector and, absorbing that sector, but it's a quantitative question whether it will do it, and if it doesn't, I sense that this is not something that you can patch with a central bank cutting interest rates. But I'll let Martin.
And I have almost nothing to add to what you said, Silvana. I think you answered the question almost yourself. So very briefly, I think there's times where fiscal policy works well, there's times where monetary policy works well, and there's times where structural policies work well. And it's the times of structural policies at the moment. We need to have this innovation stimulus that actually allows to develop new fields, new sectors, new business opportunities. And there is lots of there. And the US have done that in AI. There is probably a lot of others that are possible, but sticking to what we've done for a long time in Europe will not solve the problem. And it's a structural problem that monetary policy can accommodate to a certain extent in the way it reacts to shocks, but it cannot solve it.
Okay, I think the big question is that the fiscal and monetary policies are much shorter run policies rather than structural policies, which take much more time to feed into the economy in itself. There's a question on the left, I think, still, right? No, then. And then I will go on to an online question.
I have a question, comment. Thank you very much for taking us through such a rich journey over centuries even. I mean, talking about Eisenhower and Giselle. There's, of course, many things and many questions I would have, but let me focus on what you said at the very end. And I'm fully with you that reshoring is not what would advance us, but how about the potential for friendshoring? Because, and Robert has also alluded to this a little bit, Europe is rich, it is diversified, it is, it's a big space, economic space, consisting of many countries. We do have some allies still, I would hope. So, I mean, how is your assessment of a more, it will be a more fragmented world, but there will be huge blocks. And could these blocks be sustainable, in your view, within themselves?
Yeah, let's collect 2 and then 3 and then.
Yeah, thank you very much. I would like to ask a question rather on monetary policy, even if it's a global economic lecture. And of course, it's clear that we have to talk about everything, even if we talk just on monetary policy. But what I was struck about was your chart on uncertainty, and you also mentioned climate change various times. So climate and all this is, of course, quite uncertain, and the question is, how should monetary policy react in these circumstances? And there are always two kind of opinions, the ones who say it should become even more aggressive, and others who would say you should be more cautious in these times. What's your opinion with regard on uncertainty?
So these are great questions. So on the first one, I mean, I agree that Europe is highly integrated, but there's scope for more. I mean, talking about financial services before, I mean, there's a lot more to do there, and all in the services space, there's scope for lots of integration, more integration. And then, I mean, perhaps Europe should take leadership and look for other countries to integrate. I mean, if we're thinking or are concerned about shortages in critical inputs, I mean, there's a whole Latin America that could be a friendly, given, you know, ties from in cultural ties. And that's something there that is not going to happen magically. I mean, Europe has to take that leadership and be there. You know, and why not? Right. Meanwhile, I mean, we let China, you know, take ownership of those critical resources, and you know, if we see the threat in there, we should take responsibility for those, and try to foster those partnerships. On uncertainty, I mean, I think when you think from the perspective of a central bank, they have a clear mandate, which is to keep inflation at target, or, you know, it's price stability after all. And so uncertainty is super important because it influences demand, particularly investment, and on the side of households, purchases of durable goods, et cetera, et cetera. So it has a big impact on demand. So from the perspective of a central bank, to the extent that lower demand feeds into lower inflation, it's very important that the central bank is there to balance demand and supply. I don't think the central bank has, you know, many other tools to do much. Really, it's the solution has to be in parliaments. What central banks can do is really very minimal given the size of the climate change problem. So they, you know, again, they should stick to their mandates, of course, and the mandate might incorporate some threats from, particularly when you think about the financial stability side, because we should be robust to climate or weather-related events that destabilize the economies. But at the end, the key real actions are, you know, physical actions have to come from parliaments and from governments rather than central banks. But Martin.
Fully agree.
Okay. Before going to this question, I have one from the online. Yeah, exactly. Two short questions. The first online, sorry, and then you get the mic, right? Here's Marek Dabrowski saying, I disagree with your diagnosis of the inflation spike in Europe, contrary to the US. It was not only a supply shock, but also a demand shock generated by expansionary monetary policy between 2015 and 2022, especially during the pandemic, and fiscal policy during the pandemic. And the second, the post-pandemic stagnation in Europe has been caused not only by a tighter monetary policy, but also by the continuously declining working age population. And when working at growth figures at GDP per capita terms, then it would be much better in Europe. So brings me also to my question on this distinction between US performance and UK performance, particularly in the 2010s until the pandemic. So what's driving force between that? There might be some relation to these questions then, right?
Yeah. I think it would be helpful if you can see my slides again. Look at the demand. You know, I show you the the profile of consumption in Europe and let me see if I can go down to the, yeah. So I showed you that consumption in Europe was stagnant. That's not a story of a super expanding demand. I mean, it's a story.
Okay, yeah, okay.
It's not that we were living the boom that the US was experiencing during this period. Whether you look at incomes or you look at consumption, and sorry, I'm very slow here. But what we saw is really consumption, a big falling consumption and a very slow recovery. So that's GDP for you, but I think you can see it in demand. There was a big change in the composition of demand. We went from a balance of goods and services to a big imbalanced demand for goods, which again clash with the supply restrictions in goods production. So there's a lot of composition going on here, but by no means I can tell this was a demand boom in the euro area and or the UK for that matter. Whereas for the US, you can see an expansion that goes above its pre-COVID trend. In that sense, that's why my diagnosis is one in which in Europe we saw a much bigger supply component behind inflation. Otherwise, we would be seeing much more of an expansion in consumption. And monetary policy was there to offset some of these big falls early on during the pandemic, but then once following the Russian invasion of Ukraine, and it was clear that inflation was going to stay longer, interest rates went up very sharply in most central banks across the world. So monetary policy was tightened quite significantly. You can also, monetary policy could have done more, you would argue. You would have had even bigger falls in consumption and investment, which I'm not showing here, but we saw similar patterns there. So you can always bring down inflation much more quickly, much more drastically, but that has costs. We came out of this enormous crisis with full employment, and that's a big achievement because in the end, I mean, we didn't want to go back to the big hysteretic effects of long-term unemployment. And there will be different preferences. Perhaps, you would have liked to see a bigger recession with somewhat smaller inflation rates, but hey, we are out of it. Inflation is a target in the euro area, and we didn't lose many people out of the labor market, especially youth, young people who are the ones that tend to suffer the brunt. And as we know from the literature in labor markets, once you enter the labor force in a recession, that means worse labor market outcomes for the rest of your life. So these effects are very, very persistent, and that's what we avoided, or to some extent, despite these huge shocks. I forgot what the other question was. So there is an issue of productivity, and there's no denying that Europe has to be something on productivity, and that's what that has to be part of the discussion. And I guess the Draghi report has started that exchange.
Okay. Governor Kocher had to rush to another meeting, so he left already. Another question from...
two short questions. Exactly on that point that you just elaborated on. You mentioned that the two economies were hit by different types of shocks and with also different reactions of the economies, yet the reaction of monetary policy was about the same in terms of size of the interest rate change. So the simplistic question here is, who did wrong? Was the Fed too aggressive given the smaller response of their economy, or was the ECB too prudent? Or is there maybe another reason that would justify the same response despite different type of shocks? And my second question is one thing you mentioned at the outlook, that there are two factors to shocks, or could call it megatrends of the future, which is climate change and fragmentation, whose effect is neutral on inflation. I think there is a lot of evidence that both actually could contribute positively to inflation. So climate change, natural disasters drive up inflation, also transition policies in the medium run at least, there could be long run negative effects, but in the medium run positive, and also fragmentation is generally said to be a factor that pushes up inflation in the medium run. So, and that if they're not neutral, then they of course add to future trend inflation and would limit monetary policy scope, right? Contrary to what you have said, that they are neutral. So what's your view on that?
Yeah, so these are great questions. So on the first one, let me clarify. The shock was the same. I mean, it was a pandemic. It was an increase in energy prices. It hit them differently because Europe is a net importer of energy and commodities. The US is a net exporter of energy and other commodities. So same shock, but very different effects given the net exporting position, right? And then on top of that, I argue that the response of fiscal policy was much larger in the US on the pandemic, and that led to different impacts on activity. For the US, there was less of a trade-off. Activity went up, inflation went up. For Europe, this was trade-off territory. And I'll let you decide, where, who overdid it. You could argue that in the presence of such a strong demand shock, you could have done a bit more to tighten. But anyway, this in the end depends on your preferences over how much you want to slow down the economy in those circumstances. And but that's not for me to answer. It's about preferences almost, and how patient you are in bringing back inflation to your target. On the second question, so I think what I try to argue is that these effects from climate change or fragmentation have supply side effects, but also can affect demand. And the more we anticipate some of the catastrophic effects of climate change, if that's highly anticipated, and perhaps me as a consumer start saving for those bad outcomes, or companies withdraw investment because they don't foresee high returns in those scenarios, the more that is going to depress demand today. Okay. Similarly, with fragmentation, if we think that this is going to continue and lead eventually to lower productivity, lower incomes, that will affect investment today, at least to some extent. And so the question is, how big is that anticipated effect of future hits to the supply side? And it's conceivable that some of these effects will kick in earlier, leading to a contraction in demand that happens even before the supply side shocks materialize. So I'm not saying these effects are neutral. They're neutral in the long run, because always demand and supply end up stabilizing whether you have or not monetary policy. Monetary policy facilitates that balancing. But it's conceivable that you could have situations in which this big uncertainty and these high risks reduce demand earlier than the actual timing of the shocks. And in that sense, monetary policy, given the remit of price stability, might need to be more expansionary to bring inflation back to target from below this time. So it's a question of how much anticipation there is on investment and consumption. And it's not obvious to me, I mean, if the process, okay, so here's one, something that we highlight in work I've done before. If the process of fragmentation, say, is very gradual and highly anticipated, and investment is reacting today to that lower path for productivity and incomes, you might have a recessionary impact today, and then the central bank needs to, balance those that deficit or gap in demand.
Okay, thanks so much. I think we stop here. There will be some drinks and snacks outside, as far as I understand, so we can have a smaller scale discussion outside. Let me thank you so much for joining this event of the Global Economy Lecture. Let me thank Silvana for coming from UK and traveling next to tomorrow to US. Thanks so much for the presentation and the discussion, and see you next time at the Global Economy Lecture next year.
Thanks very much, Robert.